Welcome to Financial Literacy TV. Today we are reviewing the basics of Bitcoins and blockchains. An introduction to cryptocurrencies and the technology that powers them by Antony Lewis. In this video we are going to look at Antony Lewis's chapter on exchanges. Exchanges. Just like stock exchanges, Bitcoin or cryptocurrency exchanges are places, usually websites, that attract traders. However, you don't buy Bitcoins from the exchange itself. Just like a stock exchange, where you buy shares from another user of the exchange, rather than from the exchange itself, a cryptocurrency exchange is the website that allows people to buy and sell between themselves. The exchange itself is just a location that brings together buyers and sellers, and people go there because they know they are likely to get the best prices there. In financial services jargon, the exchange is an order matching engine. It matches buyers and sellers. It also acts as the central clearing counterparty. All matched trades appear to be against the exchange rather than between the customers directly, providing anonymity for customers. Finally, the exchange is the cash and asset custodian. It controls customers' fiat money in its bank account and cryptocurrencies in its wallet. How do cryptocurrency exchanges work? Exchanges are based in different countries and support different fiat currencies and different cryptocurrencies. They all work roughly the same way using the same 4 steps. Number 1. Create account. Number 2. Deposit. Number 3. Trade. Number 4. Withdraw. How to create an account. To use an exchange, just like a bank, you need to open an account. Exchanges are coming under increasing regulatory scrutiny due to the fact that they process large amounts of money. The top cryptocurrency exchanges match billions of dollars of buys and sells per day. Most legitimate exchanges follow a similar account opening procedure to banks, where new customers submit details and evidence of their identity, for example passport and utility bills. The documentation needed may become more onerous in proportion to the value of fiat or cryptocurrencies you plan to transact in a progressive risk-based approach. Exchanges are now big business and take these processes seriously. Once the exchange is satisfied, your account is created. Then you can log in and the next step is to deposit. Deposit before you can attempt to buy or sell anything on an exchange, you need to fund your account. This is like funding an account with a traditional broker before being allowed to buy traditional financial assets. Exchanges have bank accounts and cryptocurrency wallets. How to fund your account? In order to fund your account you click on deposit, then follow the instructions. If you are funding your account with fiat currency, presumably in order to buy cryptocurrency, then the exchange will display a bank account for you to make a fiat currency transfer to. If you are funding your account with cryptocurrency, presumably to sell for fiat currency or trade for a different cryptocurrency, then the exchange will display a cryptocurrency address for you to make a cryptocurrency transfer to. Once the exchange has detected the transfer to their bank account or cryptocurrency address, the balance will be reflected in your account balance on the exchange's website, and you are ready to trade. Trade. You can now trade up to the amounts you have deposited. For example, if you have deposited United States dollars 10,000, then you can buy up to $10,000 worth of cryptocurrency. If you have deposited 3 BTC, then you can sell up to 3 BTC for fiat or other cryptocurrency that is available at that exchange. Prices are expressed in pairs that look something like this: BTC with United States dollars or BTC with United States dollars with a number such as 8,000. The way to read this is 1 unit of BTC costs 8,000 United States dollars. Not all currencies can be traded for each other. It is really up to the exchange as to which pairs they enable. For example, you may see BTC United States dollars and BTC euros as trading pairs, meaning that you can trade BTC with United States dollars and trade BTC with euros, but you may not trade United States dollars with euros directly if you don't see euros United States dollars. In that case, to convert United States dollars into euros, you'd need to sell United States dollars for BTC, then use the BTC to buy euros. You will see a screen of other people's bids and offers. These are the prices at which they are willing to trade and how much they are willing to trade at that price. You can decide either to match their prices, which will result in a matched trade, or submit your own orders which will rest in the order book until someone matches your price, if they ever do. This is a financial market. This means that the larger amount you want to buy or sell, the worse the prices will be. This is unlike a supermarket, where you get a discount for buying in bulk. This is confusing for some people initially, but it is easily explained. When you buy something on an exchange, the exchange will naturally match you off with the person who is selling it at the cheapest price. When you've bought all that they have to offer, you have to find the next best price, which will be slightly higher. Selling uses the same logic. When you sell something, the exchange will match you with the person who is willing to pay the highest price for it. When you have sold as much to them as they want to buy, you will have to go to the next highest price, which will be slightly lower. How to withdraw? Finally, you will want to withdraw fiat currency or cryptocurrency. To do so, you have to instruct the exchange where you want it to go. If you are withdrawing fiat, you will need to tell the exchange your bank account details for them to make the transfer to you. If you are withdrawing cryptocurrency, you need to tell the exchange your cryptocurrency address so that they can make the cryptocurrency transaction. Usually cryptocurrency withdrawals are faster for the exchange to process than fiat withdrawals because most exchanges have hot wallets, as described earlier, which automate the process of sending small amounts of cryptocurrency back to users. How do exchanges make money? Exchanges make money by charging fees, just like your stockbroker. Different exchanges charge different fees in different ways. Some charge withdrawal fees. If you withdraw $10,000, then they might send you $9,950, and you would receive even less than this because of bank fees. Others charge by taking a small fraction of every trade you do, usually by reducing the amount of whatever you are receiving. For example, if you have $8,000 in your exchange account and use it to buy BTC at the price of $8,000 per BTC, then you will receive slightly less than 1 BTC, say 0.995 BTC. Trading fees are usually determined by how much trading you do, so if you trade more, the fee rate decreases according to a published fee schedule. Pricing on different exchanges. The price of any asset at a cryptocurrency exchange depends on the participants using the exchange. Different exchanges can have different prices for each cryptocurrency because of the different participants using the exchange and the different levels of supply and demand on those exchanges. Usually the prices are within a few percent of each other. If they get too out of line, arbitrageurs step in and buy the bitcoins from the exchange where they are cheap and sell them where they are trading at a premium. The extent to which arbitrageurs can keep doing this profitably affects how aligned the prices will ever become. To complete the circle of a successful arbitrage, you need to move the fiat, and sometimes this will have costs and time delays. To buy bitcoins on the cheap exchange, you need to move fiat currency there, buy bitcoins, withdraw the bitcoins, and send them to the more expensive exchange, then sell them, withdraw the fiat, and repeat the cycle. Each step has a financial cost and may not be instant. Some countries have currency controls, which hinder cross-border exchange arbitrage. This is why there can be price differentials between exchanges for some time. In late 2013 to 2014, the exchange Mt. Gox traded at a premium to its competitor Bitstamp because people found they couldn't withdraw fiat from Mt. Gox, so instead they had to buy bitcoins and withdraw the bitcoins instead. This created artificial demand for bitcoins on Mt. Gox, and the arbitrage of buying cheap bitcoins on Bitstamp and selling them on Mt. Gox didn't work because you couldn't get your fiat out of Mt. Gox. Regulation cryptocurrency exchanges perform activities that may be regulated in their operational jurisdictions. The fact that the instruments involved are cryptocurrencies does not necessarily mean that the exchanges escape local trading and tax disclosure requirements. However, depending on how the legislation is written, and owing to regulatory uncertainty, the classification of cryptocurrencies, exchanges currently operate in a legal gray area, especially crypto-only exchanges who allow trades between cryptocurrencies but not fiat. Thank you for watching Financial Literacy TV. Hit the subscribe button to stay in touch.